we shall respect you by doing a short presentation. Yes. So we shall respect the members present by doing the presentation so that you don't waste your time. You know, issues of finance are to the holder. It depends on personal motivation and also to try to take the conversation to another level. So it is always very important that, and we are doing this not for purposes of marketing, but because we are always being asked to, we do a lot of these presentations. Every year, Summit Consulting Limited will publish an annual report on banking in Uganda, which is called Uganda's Dynamic Banking Sector, the State of Banking Sector in Uganda. And we have presented the same report to investors in Dubai, to investors in Kenya, to especially through their bankers associations in South Africa, and it has a lot of interest. It is one of the most comprehensive reports about Uganda's banking sector, and I will encourage you, for purposes of you gaining insights on which bank maybe is the best and which one is not the best, because it shows you the sensitivity heat map in terms of the performance of the banks from interest income, from non-interest income, and which business models are sustainable and which are not. So that when you are also deciding on where to fix your money, you want to fix it with a bank which is already doing well, because some banks may give you high interest rate, yet their fundamentals are weak, in which case you have high risk of failure and of loss. And you remember the Deposit Protection Fund of Uganda will protect you up to Uganda shillings 10 million. So meaning that if you have savings in the bank of more than 10 million, if you have 50 million, and that deposit it would mean that Godfrey, I don't know why it shows I'm being muted. Okay, so it will show that okay, it is 3:15, and I would like to officially begin this conversation. Good afternoon once again. I'm called Mustafa Mugisa, and the people call me Mr. Strategy, my clients. And this evening, we are going to talk about investment options in Uganda, a practical perspective. We are going to focus on showing you where would you put your money, assuming you had, say, 100 million, or we are going to show you tools which are dynamic, in which case you can plug in any savings you have, and then you can see which investment option would give you the best return. So before we go, it is very important that we are on the same page. I would like to ask you some few questions, and I will appreciate that you do answer them. I had posted some of these questions on the chat. So it is time for you to unmute yourself and give us some answers, because if you're going to understand investment, it's very important that it is you are participating. It is not a preaching session. So the first question was, what are the possible investment options do you know of? So the first person, you can raise you just to unmute and talk to us. Hello, members. I'm sure you have been investing some money, so I would like to know, what are the possible investment options do you know of?
Yeah, Daisy Biaranga.
Yes.
I've been investing in agriculture, but very little outcome. I need to know how to improve on my turnover.
Thank you very much. Is it okay to tell us, when you say very little return, to tell us in terms of the percentage returns? Would you say 5%, 10%, 2% return on investment?
Maybe 10%.
Maybe 10%. Thank you very much.
Lots of losses.
Lots of losses.
Yeah.
Okay, thank you very much.
And I would like to find out how I can export the produce.
Obviously, exporting produce depends on one, scale, because exporting requires a lot of sustainability of order. So many times, many farmers are not on a consistent scale basis, whereby you can get tomatoes, maybe 1 ton, but it is only available for 1 season. So when you travel to strategic partners or big hotels, they want to create what we call a pre-qualification list for a consistent order frequency. And that is always the conversation. So they expect you to supply consistent quality, and it is always going to be delivered on time. So now you find that an average farmer is, because of the nature of the small scale, you are going to have maybe 1 ton can be available for 2 seasons, and then next time it is not available. So that lack of consistency or assurance of supply becomes a bottleneck. And that's why farmer groups and you are getting people who are involved in the supply chain, especially coordinating farmers, so that they are able to know what is selling, which has demand, and then you are able to make sure that you supervise it. Makes important. That's why you see organizations like BAT have consistently been performing very well on the stock exchange, despite a very constraining regulatory regime, because they tried to fix the value chain. They control the value chain from the farmer up to distribution to the final consumer. So despite the challenges, they end up having reliability of supply. And I thought that is a point for agriculture which you might need to know. So then as part of this conversation or a strategic perspective, you have to ask yourself, what do you see is the potential produce given the kind of land where you have it, which you can sustain by working even without growers to ensure supply? Because everything when it comes to earning from agriculture is constrained by reliability.
Okay. Thank you.
Welcome. Do we have another person who have any investment option just for you to?
Yeah. Hello. Can you hear me?
Yes, I can hear you.
Yes. So my question is more of a question on the issue of investment in property.
Yes.
I want really to find out what are the prospects, but also what are the options, and how do you particularly evaluate an investment in property in order to identify returns and decide, whether an investment is worth it or not. Just to elaborate, there are a number of options. There's purchase of land and construction of a rental property, for example. There's purchase of existing property for rental purposes, and those kinds of things. My kind of question is always around, how do you decide whether, say, an investment property that is available on the market for 400 million is worth investing, given the kind of rental inflows that sellers tend to kind of publicize on the adverts?
Thank you very much, Sam. Just a heads up, we shall go deep into investment property by giving you the numbers and also taking consideration of all the returns, risks, and the initial investment, and of course the residual value, appreciation value.
Yeah.
But for any investment, we consider 4 factors, and these ones should be defined. You as an individual investor in what we call your investment policy statement. So if I have funds, say United States $10,000, before I begin allocating how to invest it, they'll draw what I call an investment policy statement. So an investment policy statement is speaking in terms of my risk appetite or the objectives of the investment and the goals I have. So when we are looking at the goals of an investment, you look at one, as an investor, do you want capital appreciation? In which case you are looking at long-term growth. So then you have to focus, if you are going to invest in shares, you focus on the fundamentals of the business you're going to invest in. If you're going to invest in property, you focus on the fundamentals of the particular geographical area you are going to invest in. For example, when people were speculating about, for example, if you go to Hoima around Chikube, Kiziramfumbi, that junction, that road, the property have increased almost by 50, 100%. Why? Because they are speculating. So, but the question will be, Are you intending for capital appreciation, in which case you are looking at long-term growth, and that means that your fundamental will be coming that in 5-10 years time, I will be having my money I've put in to be more in terms of capital gain. The second factor you consider before you invest or you allocate to create a portfolio is what we call capital preservation. So this is why many times, unless your primary business is real estate, I want you to get me properly here. People like Knight Frank or other property retailers, I buy now and sell tomorrow. Unless that is your primary business, in which case you have created the an ecosystem of people will come to you and say, do you have property or not? So that you are looking at, for example, the business of property is different from a person who is an employee of government or anybody and just buying land maybe to build their own home. So before you invest, you're asking yourself, is my objective to preserve my capital? So this is why you look for low risk assets or investments which have low loss of capital. So this is why you see people going for treasury bills. But in Uganda, because real estate has consistently year on year been appreciating, we have seen people putting money in real estate because there has not been really a big shock that people they have lost significantly. The only risk is initial risk on when you're acquiring land, in which case you could be defrauded. But once you have a good title, we have seen generally that the property has been appreciating. So people therefore, because anybody doesn't require brains to invest in property, we usually call it an investment of the illiterate, for lack of a good term. But now, this is why you find that many people who invest in real estate, it's because they are not understanding how to preserve their capital in any other form apart from just putting it in land, because they know the fundamentals have always been positive. So if your objective is preservation, then you are going to say, let me invest in this property. But now you realize that if you are still young, dynamic, and you are able to take risks, you are still having other income sources, maybe the return from a property may be lower in terms of what we call opportunity cost and also inflation rate to give you a better return to win. So that's why you'll go into more risky ventures because you want to venture out. And then, of course, third factor we consider is speculation. Are you a speculative investor, in which case you are feeling that tomorrow they are going to construct a main road so I can buy land here and then it is going to become better, then I will buy. So in that case, people like that, you have seen them always focusing on initial public offering of stocks. But of course, some of them have had their fingers burned. Others have gone to land locations. When the government announced the construction of Entebbe Express Highway, many people rushed to buy land around those areas because they knew they would get compensation. So you realize that these kind of people are speculators. And then finally is the current income growth, in which case your main focus is on top performing maybe investments and you want to get a high turnover margin. So now when you look at minimum, these are the 4 things you're going to look at from an investor point of view in deciding whether to invest in property or not. So if you are going to be looking at long-term growth, you can now identify a land somehow far away from the town because it is going to be cheap. But now you are a long-term player, you are a long-term game player. So you wait, you know, by maybe 10 years, this land will be appreciated. Now, the biggest challenge we get is getting a short-term loan, maybe a loan of 3-5 years to buy land which would mature and give you value in 10 years. So once you mismatch your capital with the property or the assets, it becomes very catastrophic because the bank is going to need money now, and then you are not going to have the land the other side. So this is why, as we speak now, government, the Uganda Bankers Association has over Uganda shillings 2 trillion in collateral, which people got loans but they couldn't pay, and they have to begin now trying to find a company to dispose it of. So that will go to show you that not everything in real estate is actually good. I don't know whether that answers your question, but that was just an overview on why you would decide on which investment. Sam, is that explanation is somehow answering your question before we proceed?
Yes, I think it gives me the kind of background and kind of the basis on which such decisions are made. What I mean, without dragging the whole discussion into detail, I wanted to kind of ask was whether, those kinds of investments do outperform inflation, but you've hinted on that as well. But if I could probably chip in another question, you talked about treasury bills. What are the rates, and do these bills currently outperform inflation?
Let me show you. So that is the main focus of the presentation today. We are going to look at this is some of the common investment options available. Fixed deposits, 90-day treasury bill, 364 treasury bill or 65, savings accounts, of course, those kind of unit trust and blah, 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 then plus real estate and then farming. So we are going to simulate for you a model based on data, which we shall show you the data sources. And then you are able to get a better picture on inflation. So time deposits, I will again share this slide, so I don't want to bore you or waste your time with telling you things which you know. But in brief, when we talk about time deposits, is you have some money in a bank. So instead of leaving it on a current account because it doesn't earn money, you go to the bank and agree to deposit it on a given term, maybe 6 or 12 or 1 year. And the bank will agree on how much interest they will pay you, because banks use our money to lend to those who need it. And then you will earn interest. But that income you get from the fixed deposits will be subject to withholding tax of 15%. Then, of course, there are treasury bills where government is managing macros in the economy, where they will borrow from the public by issuing treasury bills through the central bank. So usually the government will issue treasury bills which are of a duration of 91 days or 364 days treasury bill. So government usually auctions and invites for bids. Those who are the successful bidders, they will be offered, and then of course they will therefore be lending to government. They will have that paper as they take the cash of those who have won, and you'll be earning interest depending on the fact sheet of the treasury bill, because every time they are auctioned there is an amount. So this is why it is very difficult for an individual investor to just buy treasury bills, because many banks and unit trusts and other collective investment scheme fund managers already have a lot of information, and they are more quick in terms of bidding, and most of the time they are always going to be the one buying these bonds. So the income which you will get will be subject to a 20% tax. This means that if you give your money to a given fund manager licensed by the Capital Market Authority, and you have said they should buy these treasury bills, or they use it to buy part of your money to buy it, then you'll be earning interest and it will be charged at 20% of that. Usually we say these are a low risk or almost no risk investment, because there is no government will not default. It may delay, but they will always, there's a time when government delayed, but they will always meet the obligations to this. So it is now when if you look at the 4 factors I gave you, that could be a way of preserving your money, because you know it is not going to lose it. The question you asked of are those the other investments going to outperform inflation? At Summit Consulting, we do market intelligence, and we collect data as far as 1980s. This is from public sources, from Bank of Uganda, from Ministry of Finance, from Bloomberg, from World Bank, from International Monetary Fund, from other fund investors, Central Bank of Kenya, and various central banks. So we collect this data and put it into our analytics engine. And then we are able to begin showing you how Uganda economy is performing in relative to other economies, but also now internally. Now, when you look at this, if I just try to expand, you will see that the green is a 91 treasury bill rate. Then we have a 364 treasury bill rate. Then you have a fixed deposit rate, which is paid on fixed deposits. And then you have inflation. So what this chart shows you that Uganda's performance of the key macro indicators is susceptible to key changes in the economy. And this is highlighted by every time there has been an election. That big circle is relating to election cycles. You have 2006 election, there is a bubble. Inflation is higher than all of the other incomes. You come to, of course, you see 2008, somehow there is a bubble, but you know that came up global collapse of the financial system. And then you have more prominently in 2011, also there is a bubble. You can see it is increasing. Only in 2016, when there was an election, that we don't see inflation going very high. So this is why, if you are an analyst, you are using these insights and you have money, you can see the best investment from 2006 has been a 364 treasury bill rate, because it has been completely outperforming all the rest, and other than in 2018 when it tried to come down, but it has constantly been good. And even up to now, in 2021, you have seen even at January, it is still very high. 364 treasury bill rate is still performing very well. So we would therefore encourage anybody who has savings, instead of putting it in any other investment, that treasury bills, especially now for banks. That's why you see in many banks who made profits, they put a lot of money in treasury bills. Why? As a way of investment diversification. Sorry. So I don't know whether my colleague Francis, you have something to add there, or I continue. Francis.
You can continue, Mustafa. It's okay.
Okay, fantastic. So then, of course, some of you asked about fixed deposits, and obviously, if you look at fixed deposit, we have looked at the analytics of all the data since 2000. The best, highest, best case scenario of the market, the top bank which has ever paid the highest interest on fixed deposit was 13%. So if you have an amount of 100,000 and you invested it, you fixed it with the best bank, which is giving you 13%, it will be subjected to 15% withholding tax. Of course, we have a running rate inflation of 6% annualized. And then, of course, you have a standard deviation of 2.31. And then you have a risk-free rate, assuming your opportunity cost 12%. So you will find that with this fixed deposit, much as in nominal terms, you'll earn 13 in the first year, 13,000. In real terms, after you remove the effect of inflation and opportunity cost of another investment you have put in, you'll be earning only 4,496. So that is very important, so that you know, because many of us, when we are investing, we look at only the gross income. We don't look at the income after tax, and also we don't look at the income after inflation, and also the income after opportunity cost. And that gives now a picture that now we compared this fixed deposit, the best rate, with a 91 treasury bill rate. So whereas in a fixed deposit, Francis will show you this in detail, because we shall give you the data. Just want to show you. On treasury, 91 treasury bill, when it is annualized, the best case scenario annual interest rate has been 2.18. So if you invested the same 100,000, it would give you an annual return of, by the end of first year, of 8,706. And that would mean 861 in real income after inflation and the opportunity cost. So when you compare now a fixed deposit with the 91 treasury bill rate, it means that a fixed deposit is far better with a treasury bill rate of 91. Why? Because as you can see, somebody with 100,000 and invested in fixed deposits gets more, 4,461. This one is getting only 861 by the end of first year. Let us also now show you this 364 treasury bill rate, which we showed you in the macros. Now, when you look at this one, if you have 100,000, interest rate is 12.46%. You can see at the end of the first year, you are earning something like 3,537. So that is coming far better than the fixed deposit. But remember, the fixed deposit will use the best case scenario of a bank, because different banks will give you different fixed deposit rate, And that depends on your term of the fixed deposit, also depends on the amount of money of the fixed deposit, which gives you the bargaining power of the rate you will need. But remember that rate will also not be too much because the bank has cost of funds. Because if it is going to borrow it, it is looking at the spread. If I am paying 13% on fixed deposits, it means that I have to add a premium for administration and so many other costs. So if I add 5%, it goes to 18% as my cost of lending to SMEs and my customers. So meaning that banks, they need to be so efficient. If they are going to give you a very low rate, it will not go maybe below 8 or 9 because it is almost impossible for any bank to survive. Why? Because the more it goes, your cost of capital, the cost of fixed deposit, the more it goes, the more it means that the bank will be too expensive in terms of giving loans, and people will run away customers. So it is self-defeating. That's why, therefore, a 364 treasury bill rate, based on our analytics, is far practical, prudent, and better. And if you have fund managers, I even now would recommend that you try, you ask them to invest. One of the biggest things which has happened in Uganda has been the growth of SACCOs, collective investments, and of course unit trusts, which has given rise to fund managers and the many unit trusts. Unlike fixed deposits, unlike 91 treasury bill rate and the 64 treasury bill rate, unlike all these ones, and of course 184 treasury bill rate and 182, unlike these ones, they have a fixed term. If you want to get your money, sometimes you will not earn interest on them, or you will get it is difficult to get it to retire them before the term. So because of that, unit trusts are growing because they can meet liquidity needs, especially for many Ugandans. Some of us, we don't plan. So you put your money and then something bad happens because you don't have maybe a health savings scheme. We don't. So when you get a problem in the family, a sick person, immediately you begin trying to liquidate your assets. And that's why property has been very bad, because people put all their money into property, and the property, sometimes it is a long-term game. You make money in property when you are not selling under distress, or you are not having a forced sale. But many times, if you are going to be having a problem and you want to sell, you find that even if your property is arbitrarily highly valued, there is no willing buyer, unless if you cut the price significantly and it goes. So because of that lack of liquidity within the property arrangement, because my property may be in Kolola and I'm valuing it at 1 or 2 billion, but that is what we call paper value. It becomes real value if you get a real customer offering you that money there and there. So because that is not always possible, it becomes very difficult in case you want to get cash. And that's why unit trusts are growing, because you can withdraw your money anytime for that. So also we looked in East Africa, we find Kenya Mutual Fund is offering, you can see 18.7%, the highest of all the others you have seen. So if you have very good fund managers and you can do cross market trade, and you invest in with Kenya Mutual Funds, we shall show you some fact sheet from some of the performance of the mutual funds in Kenya. Of course, the size of the economy is big. It would return higher compared to what you would get in Uganda on any of the investment options available. 8,404. It is doubling, almost doubling what we had shown you as the best 364 bill rate. So, ladies and gentlemen, I'm going to stop sharing my screen and invite my colleague Francis to take you deep into the options. But if you have a question so far, ask it as we go, as Francis changes over. Thank you very much. So to you, Francis, I'm going to discontinue my screen share. Francis, are you there?
Sorry, just a question.
Francis.
Question on, hello?
Yes, sir, you can continue. We can hear you.
Yeah, I just wanted to ask, you mentioned investments in Kenya. How accessible are those to people in Uganda? Where would somebody go to invest money in Kenya?
Yes, we are going to answer your question in the due course. Let us first show you data. Francis, I can see your Excel sheet.
A question here as well.
Francis, yes, how accessible?
A question.
Okay, go ahead with the question.
Yes, from what has been presented so far, I noticed that those investments would largely make a lot of sense with guys who are having quite some amount of money to invest. What options are there for small people who have small monies to invest or save, so that they can be able to gain traction a little faster?
So we are going to show you high risk investment options like business, and of course farming, so that now you can know where do you put money. But for the record, you don't need to have a lot of money to participate, for example, in a unit trust. You don't need to have a lot of money to participate in a collective investment schemes. You don't need to have a lot of money to participate in circles. That's why Bunyoro Kitara Kingdom, BKK Hard Talker Forum started a savings scheme, because the opportunities available to a saving group are different than available to an individual. So a savings group therefore gives the opportunity of somebody with little money to tap into opportunities that are offered by options which require a lot of money. So to you, Francis.
Thank you very much, Mustafa. I hope my voice is very loud and clear.
Yes.
Okay, I'm going to take you through a deep dive into these investment options, and I'm going to show you a practical feel of how to invest in these specific securities and other options. We are going to start with the fixed income and drive over to agriculture bit by bit. And I'm going to be as practical as possible. So first and foremost, before you invest, there are a number of risks that are exposed to your specific, to your funds. The biggest risk exposed to your specific funds is macroeconomic risk, that is systematic risk. To begin with, I'm starting with inflation. Inflation is one of the biggest macroeconomic risks. Now, before you invest, you have to do what we call market research, and market research requires you to fish out specific macroeconomic indicators. This information is readily available on the internet, on the website of Bank of Uganda, and on a number of other websites, which I'm going to share with you, that you can use to specifically dig out and dish out this. So I'm going to start with a simple investment that is from the portfolio we have. I'll start with the annual treasury bill. So the annual treasury bill, let's say you have 100,000 US dollars. By the way, these investments are not only for the big, because you have a significant amount of money, you'll get a specific return. They are not limited in your portfolio. So to begin with, let's start with investing 100,000 US dollars in the treasury bill on the market. First and foremost, you'll have to get what we call a primary dealer, and primary dealers are top financial institutions. The number of financial institutions that are already ready. You can also go through a financial advisory firm. Summit Consulting is one of those. And the prevailing rate of the treasury bill in the past 12 months is 12.4% per annum. So your investment, your 100,000 shillings, your 100,000 US dollars or shillings will get you up to 12,400 in the following year US dollars. That is 12.4%. However, these returns are not just subject to to interest. They're also subject to inflationary discrepancies. So the prevailing inflation rate in the projected 10-month average is around 6%. So your funds will be depleted at a 6% rate. So that means by the end of this investment year, you'll have around just about 3,491 US dollars or Uganda shillings in real value. So the value of your 12,000 is just worth around 3,000 due to inflation in the next year. Of course, you'll have, in nominal terms, you'll have around 12,400 available in your hands, but however, it will only have value to buy products worth 3,491 by the end of the year. So that is, and remember, treasury bills are subject to withholding tax of 20%. 20% is held up by the government. That is around 400,000. That's around 2,480,000 US dollars will be held up by government, and that means your net cash flow will be around just around 109,000. So your rate of return is around 9.9%. So from the 12.4% that was previously mentioned in your yield, your actual return is around 9.9% in real value. This money here, you can invest with treasury bills. You can invest from just about 100,000 Ugandan shillings, going upwards. So you'll have around 9.9%. So let's go to the next investment. Remember, this is the annual treasury bill. So our next investment is the 91-day treasury bill, which is around 2.18%. Now, remember, there's something that investors usually forget. When Bank of Uganda tells you that an investment is 9%, is giving 9% every 91 days, you have to do what we call annualizing. Annualizing means the 91 days are not specifically what the 9% is not what you're going to get in 91 days. You're going to get just a portion of that 9% in the 91 days. And you'll have to invest 4 times in the year to get the actual 9% that is provided to you. So with 91-day treasury bills, a person who has invested 100,000 Ugandan shillings will get just about 8,706 shillings, which is returned subject to a times 4. That means you've invested 40 every 91 days you're investing. You'll only get around 8,700, and that is around the inflationary rate, which is 6%. The inflationary rate is 6%. That means you only have value of 861 shillings by the end of that term. So which gives you a return of around 9, and it's being highly discovered. Mustafa, you have something to say?
No, it's okay. Continue. Your network is poor. That's all. Somehow there's a break. But you continue.
Okay, no problem. I hope I'm now clearer than that.
You are clear. Yes, you continue.
Okay, wonderful. Let's continue. Now we're going to go to the fixed deposit rates. So now the fixed deposit rates, of course, the prevailing rates right now are averaging just about 8.78%. So that means for your 100,000, you only get around 8,784 Ugandan shillings by next year, which is just about, which will give you a net return, a real value return of just 7.5%. 7.5%. So compared to our portfolio, for the 3 portfolios we are having, the annual T-bill is doing fairly better. So now, to continue with now let's go to the Kenyan mutual fund. I hope there are no questions in that area. I'm asking if there's any question, you can ask me as we are moving forward. I'm going to be I'm going to move a bit faster due to time, but I'm going to make sure everything is clearly understood. And now let's go to the mutual funds in Kenya. I had a question where they asked us how accessible are the mutual funds in Kenya. With financial advisory firms, you'll have clear and transparent transactions with these mutual funds. You should not worry about contact. You can talk to Summit Consulting. We have a number of financial investment banks that we are working with in the Kenyan mutual funds. So this is an example of one of the mutual funds in Kenya with the net return averaging 18.17%. That is a very high return. That is over and above the risk-free rate. We have a risk-free. We usually compare it to a risk-free rate, which is our opportunity cost. The risk-free rate is the rate of the treasury bill, the annual treasury bill we have on the market. So against the annual, we discount these investments against the annual treasury bill on our market. And as you can see, for 100,000, you have for 100,000 US dollars, you make up to 18,000 US dollars in gross returns. Now on net returns, you make about 115,000, which is around a rate of return of around 15.4%. 15.4% is a very high return on the market. This is from a Kenya mutual fund, and this is how a fact sheet from a Kenya mutual fund looks like. I hope we can all see this. We can all see what we can all see what is on my screen currently.
Yes, it can be seen.
Yes.
Yes, continue.
Okay, wonderful. These are returns from one of our partners in Kenya. You can see they have what we call quarterly returns. Their quarterly returns in the past financial year, that is 2020, they made a net return of over 18.75%. 18.75%. That is a net return after fees, after commission fees, after every other thing that is involved. With mutual funds, however, there is what we call fluctuations. You have the returns are not usually guaranteed. They will give you a range of returns they will tell you from around 15% to 20%. So it depends on the market dynamics. Now, for instance, as you can see here, in quarter 2 2020, when we had a lockdown, a number of businesses were shut down globally. You see, this was a global lockdown, a global pandemic affected, and that's why you see the return dropped from 4.86% to 2.77%. But however, they were due to these mutual funds. Mutual funds invest in a number of securities. So the diversification managed to pull it back up to 6%. And the number of asset classes these mutual funds diversified. Now, usually there are different kinds of investors. There are investors who can monitor the markets and they have adequate information on the market. And then there are other investors who prefer money market funds to invest for them. These are unit trusts. They will invest for your funds and they will give you a return based on what happens on the market. So this specific fund invests in currencies, precious metals like gold. The currencies invested in are usually not, the dollar is a very high risk currency. It usually fluctuates every day. So we go into funds that fluctuate, that are less volatile. There are also commodities like gold, like oil, that are also invested in oil futures. So with these money market funds, with these mutual funds, they usually invest in areas you're not usually exposed to. They help you invest in those areas, in those places, and you get high returns. As you can see, in the 2 years, 19% and 18%, this is a very high return on the edge of investment. So going forward, this is the Kenyan mutual fund. There is also a mutual fund here in Uganda from UAP. These are insurance companies, but of course, there are a number of insurance companies providing these funds. However, we look for the highest return funds based on our market intelligence. These ones return an interest of around 12% per annum, but it's not guaranteed. It is up to. You should make sure you listen to them clearly. They say up to 12%. So if you don't get the 12% per annum, this is not guaranteed by. That's why we call this high risk investments. Higher risk investments. Now these are the mutual funds, and that is they'll give you around 12%. So if you look at our portfolio now, for the mutual funds, the Kenya mutual funds have the highest rate of return. That is for 15.44%. So now let's now switch to other investment options, and these are the most common investment options that are exposed to Ugandans, especially those in the diaspora, and even us here in the country. So let's start with the real estate. Real estate has had keen interest from a number of us. We are all interested in knowing what are the gains from real estate. Now there are a number of assumptions you have to take up. There are a number of conditions you have to look up to before you invest in real estate. First of all, you look at the market value of that property. How much it costs when you're going to build it, how much it costs for you maybe to buy it, how much it costs for you to develop the entire property, to put it up. Now we are giving here a case study. This case study is of a property, is of a company that exists. So I'm giving you a real life case study so that you feel the returns and how you're going to monitor real estate particularly. So remember, real estate is exposed to property tax of 20%. 20% property tax. Of course, I'm going to give you other tips on how to reduce the burden of this property tax. Now, when you have property, let's say this is an example of rentals. You have a specific amount of money that is set aside for maintenance. That is the utilities. So here, for this specific property manager and property owner, this is it's a property owner. They spend at least 10% of their revenue maintaining their properties. They have around 15. This property investor has around 15 apartments, with each apartment going for rental fees of $1,200 per month. Of course, you don't need, this doesn't necessarily have to be this high, but this is an example. This is a real life example. And the average occupancy rate we've had in the past 12 months, based on market research, when you build a property for rentals, you can have, the best case is 60% occupancy. So you have to be aware about occupancy. Don't just invest in real estate thinking that people are going to come and just start renting. The available option is just around 60%, 60% on average. And this is a very big property dealer. They are having rentals of around 60%. Now, on a monthly income for this specific 15 units is around 10,800 US dollars. With now the costs are around 3,200. So if you look at their net cash flow, they are making a net cash flow of around 14,000 US dollars every month, which makes an annual cash flow of around 168,480 US dollars. Now remember, this is an annual return that we are receiving here. However, there are other conditions you have to look at when you're investing. Of course, you're receiving this annual return, but are there other options? How do you compare to inflation? How do you compare to other investment options that are available on the market? You usually have to compare it to inflation tendencies and also the risk-free rate, the securities that guarantee you no risk exposure and and still give you good returns. So first of all, we look at the land value of the property you have purchased. So for this specific property, this property is around 100,000 US dollars, with an appreciation rate on average. There's been a 5% land appreciation rate annually, on these properties that the company has had, and they usually increase their rentals at 2% per annum. But remember, this is now what you have control over, and that's why they have occupants of around 60%. Now, the discount rate you're looking at here is the risk-free rate of investors, or that is the rate at which treasury bills are being purchased at, and the returns you're getting from treasury bills. So you're going to compare these returns from your real estate to treasury bills. So let's say, for instance, investment, and these are rentals. So in the first year, you're going to make around 168,000, which gives you a real return after discounting for opportunity cost at around 149,000. This is a negative rate of return of negative 83%. So you're making you're losing around 83% of your investment over time in the first year. So by the time you make your return, you recover your money in real estate. For this specific case, it will take you 6 years to make to regain a positive return from your investment. That is around 2%. So these are models that are developed for that specific area. So by the time you reach 11 years, so it takes 11 years for this specific investment to get a higher return than the annual treasury bill. And this is on real estate. Mustafa, do you have anything to add on this aspect of real estate?
Thank you, Francis. Thank you very much. What I wanted to add was, as you have properly shown, usually we look at the amount of money you have spent. Remember, by the time you begin earning 12.4%, which is the highest rate, you have invested $1.1 million in real estate. Now, if you had put this same money in another investment option, obviously that person would have been very far compared to you. That's what I wanted to give a comparison so that somebody is able to understand the opportunity cost better. Thank you.
So I have a question.
Yes.
Yes.
Yeah. So you've used a discount rate of 12.4%, and arrived at these figures, which are not too glamorous. What would the situation be if the source of funds was loan capital? Would property still be viable at all? Because under loan capital, you'd be going for what, 23%?
Francis, can I first reply, or you want to respond first?
You can first reply, Mustafa. It's okay.
Okay, thank you very much, Sam, for that question. Most of the time, as you can see, getting a loan to invest in real estate, which is not your primary business of buying to sell, is obviously not advisable, because at the end of the day, if it was making money, banks would be doing it a lot. Nobody would be out competing banks from that, because they have more research, better investment analysis, and they are always having money which they are scanning the market to put that money. So that is why many times when you get a loan, if you are investing in property, it is because you have a side business against which it is going to provide cash flow. Getting a loan to invest in property is what we call an example of mismatching financing, where a long-term asset is being financed by a short-term cash flow. And by the time the bank begins demanding the money you don't have, so you end up going to sell the property and you end up going into more problems.
No, but some of them are into long-term financing for property. They, mortgages, for example, they would go for 20 years. This computation only goes to year 11. If you had a 20-year mortgage at say 18%, that would be, in terms of duration, that would match your investment, because that's long term as well. It would still not be worth it going by these computations.
Sam, let me give you facts. If I get $100,000, many times somebody going to property by getting a loan has some factors present. One, they already inherited land or they own the land. So they are going to just invest and expect people to put on apartments and people begin renting, or a hotel whatsoever. Is that true? So because you are not going to get a loan to buy land and also build, that loan, the chances, even the bank will not give you that loan to you unless you demonstrate another business which is already going to service the loan. Because even if they give you a 3-year grace period, you are practically going to be struggling over the lifetime of that project, of that business. So meaning that when you get a loan to buy property, to develop property, the banker essentially is not lending you because of the property appreciation and income. It is lending you because of the underlying business you promised to put in the business. So if you are putting up a hotel, they are lending the business of the hotel and the cash flow of the hotel other than the property. Because traditionally, sometimes when we invest in property, it is a feel-good investment to look at it and say, have it. But when it comes to the numbers, it fails significantly, as you can see from the year 0 up to year 5. So this is why you, in the normal course of your business, you get a cash flow and it doesn't have immediate use. And then because you say, let me buy a property which is lower priced, because you know it is going to appreciate when there is effective demand. But also remember, in Uganda, one of the biggest challenge which has been in the market of property has been a high risk of money laundering within the real estate business, whereby somebody can launder or clean their money by buying property at a higher price, because any money they will get from there will be good for them in terms of it will have been cleaned because it was illegally obtained. So because of that risk, you, an investor who has got clean money, it becomes a high risk exposure. If you did it, the only way you benefit is if you found the person who is wanting to launder is the one who approaches you and wants to buy the property. For example, if somebody is a beneficiary of a corruption scheme, they are willing to pay for a property as long as they need it to put it, maybe their home. So it will create an arbitrary good investment because you will sell and get an income. But it will not be a sound long-term viable venture based on the analysis. Francis, back to you.
Thank you very much, Mustafa. Yeah, it has been clearly stated. And another perception property owners have usually is when they are valuing real estate, they look at the lucky buys. There's those buys we call lucky buys, where an individual investor purchases land and next year someone demands the land. But that is not guaranteed. Those are lucky buys, and it's very complicated, and that's why financial institutions like banks are struggling to sell off property. Property is one of the most unstable incomes, especially in aspect of recovering money, liquidity. It is very slow on liquidity. Most investors have the perception that when you buy land this year, next year it will have gained 50%. But selling off if your land is 20 million this year, next year it's 300 million. How many ready buyers are already there to purchase that to purchase that land immediately? How many buyers are readily available to buy that land at request? That's one of the issues you have in that aspect.
Fantastic. Our time has gone. We have 4 minutes, Francis.
In that area, yeah.
Francis, we have 4 minutes.
Yes.
We can show the agriculture scheme.
We have 4 minutes.
We can show the agriculture scheme so that
okay, let's now rush to agriculture. So with agriculture, the key word is standardized contracts and standardizing operations. Most individuals in agriculture, we've been advising a number of farms and individuals in agriculture, and the ones that have succeeded mainly have standardized contracts and standardized operations. What happens is, when you look at the numbers of agriculture, most of us tend to look at agriculture as a very low cost a very low-cost investment. Agriculture is not a low-cost investment. You have to standardize operations, get standardized contracts with contractors. When you go to companies like, this is an example of Hoima Sugar, they have what we call a standardized contract. A standardized contract gives you guaranteed returns compared to the market value. Usually a market value is so high, they will tell you a kilogram of a certain produce is at 80,000, but these standardized contracts are only giving around 20,000. However, 20,000 is a more certain figure. With your 80,000, you will keep your produce for a long time. Number two, with these investments, always, if you're investing and you're not available to monitor, invest in produce that is not consumed by the locals. Do not invest in food crops if you're supervising remotely. Invest in produce like cash crops. Invest in items that cannot be eaten or consumed by the locals, and also have standardized contracts. So this is an example of a successful investor in produce. This investor has invested in sugar canes and in trees. But however, the contracts that they have are standardized contracts. They receive a small margin of returns, but however, they are guaranteed returns. They are guaranteed returns, and they've broken even. In 2020, they managed to break even completely in investment. So you have to look at agriculture as a business, as a normal business. Employ serious professionals. Yeah, professionals in agriculture. If you're bringing contractors, bring contractors. Do not use, if you use locals, you'll always have what we call collateral damage. So agriculture, for this specific investor, has given them 86.93%. On average, out of the 56 investments of agriculture that we have provided financial advisory, around 36 of them have been able to get returns that are higher than 60% because of what we call standardized contracts. There are certain areas you have to also look at when you're going to invest in agriculture, certain assumptions. So for instance, you have to look at the market risk of your industries. What risk are we exposed to? The industry is growing the economy or not? You look at the risk. You also look at opportunity cost with current treasuries. Are we together? Yeah. So there are a number of options there that you have to look at in that aspect. Mustafa, if you can add something, I think my time is up. That's why I'm a bit rushed in this area of agriculture.
Thank you very much, Francis. That is the time we had today. We thank you very much for allowing us to share with you these insights. And we hope you succeed. Thank you. The call shall be ended. If you have any questions, you can ask. Thank you. Bye-bye.